Great.
People are joining.
So it's 2 o'clock. Do you want to start?
I think so. Let's give it a go. People will carry on joining as goes through, and you can always catch up on YouTube.
Okay, so welcome everyone. Hope everyone is safe and keeping out of trouble, keeping away from COVID. And today, Edwin is going to talk to us about keeping out of trouble when you're doing for the public inspections report on auditing. So Edwin needs no introduction. He's old hand at this. He knows what he's going to tell us, and we know what he's going to tell us, all the things we don't want to hear. But Edwin, the floor is yours.
Thanks, Dan, and good afternoon, everyone. Just from a timing perspective, would you prefer one break or two? Just to clarify how you'd like to run it. Stan, should we go for one break or two? Danny?
I think we should take two, one after each hour.
Okay, great. Fine. Okay, so then we'll break. We'll just see exactly where we are on the slides, and then we'll break then after an hour.
Got to be able to refill the coffee.
Okay. Especially after those of you that have had lunch, it's even more important. So what we're going to be looking at is the overview of the public inspections report, the 2020 report, which was issued in March this year. So the RBA then collate the results of all the inspections that they've conducted. And that looks at both the inspections from a firm as well as from an engagement file. And as in the previous report, they've then summarized that into its main themes and provided some very interesting graphs as well, which we'll also be touching on. And then we'll be looking at understanding then how do we address some of those issues that have been identified, and looking at a root cause analysis and remedial action plans, because this is where we take an understanding and introspect on that information, those deficiencies, and then try and plan for the future so that it's not something that then recurs. Just from an administrative perspective, I'm going to be trying to watch the questions. So if I can ask you to please either raise your hand, or I think Stan and them just prefer if you can just submit your questions in the Q&A, and then I'll read them out and respond to them. I hope you did receive the slides in that, and then let's get started then with the learning for today. So when we look at the public inspections report and the objective of the inspections report, and the primary objective is to promote consistent, sustainable, and high audit quality. And it's important that we realize that this then applies to all audits. We'll see in some of the slides that the regulator has picked up and is concerned that audit quality on sometimes some of the larger entities is different to the audit quality that's applied across some of the smaller audits. You know, I'm in the middle at the moment of just reviewing a attorney trust audit, and you know, it's very considered a very high risk area. I've got some of my clients that they actually refuse to do the audits of attorney trusts as well as the estate agents and body corporates, because of the risk associated, they believe, with those. And it's something that some people have strategically decided to stay away from. But if it's an area that you are focusing on, then one needs to just make sure that one has the necessary skills, and that's what you know, CPD is all about. And when we look at the regulator's most recent report, the report is summarized in a thematic analysis of significant findings from the firm. So that's the application by the firm of the quality management standards, ISQC 1, in its present state. There is a new quality management standards coming up, but that's effective in 2022, so not something we need to worry about immediately, but you should start planning for that. And the results of these findings, this inspection report, is that it summarizes the results of inspections that took place between 1 March 2019, or say 1 April 2019 and 28 February, sorry, 1 April 2019 and 31 March 2020. And why is that important is because, remember, we're in the 7th cycle now, and that has an impact, because when we look at what's actually happening in the industry and the concerns, what we're looking at now is information as that's almost a year old. This is something that the profession, a lot of these findings are repeat findings. Particular concern to the Hi, I think I'm back. If I can just have a thumbs up if you can hear me. For some reason, I just lost connection. I'm not sure what happened. Just if I can just have some thumbs
Yes,
up or
good.
wave hands or...
Yeah,
Can
you're back
hear
on
you.
now.
Okay, great. Okay. So, as I was saying, we're now in the second year of the seventh cycle. Remember, these work in 3-year periods. And what's important is that when we look at the objectives of the report, it's aimed not just at auditors, it's aimed at anybody responsible for audit quality. So that would include partners in an auditing practice, includes users of financial statements, includes regulators, SARS, the stock exchange, etc., or anybody who's interested in audit quality, and obviously audit committees as well. So when we look then at the focus, the 7th cycle themes, so the overview is a significant number of prevalent deficiencies in areas, and I would say all of them relate to documentation, and sometimes there's lack of, and as a result thereof, lack of compliance with specific auditing standards, specific audit requirements, sometimes the code of ethics, sometimes legislation, and therefore we'll be then going through those in detail. There is also a focus now on a remedial process whereby not only does one need to identify deficiencies, but one also needs to determine, well, what's given rise to the non-compliance with an auditing requirement, with an auditing standard, with legislation or ethics. Because if one can understand the root cause, then one will be able to develop a proactive response so that there is then a better likelihood that there won't be a continued error deficiency being repeated. The 7th cycle has focused on JSE accredited firms, so those audit firms that have JSE accreditation to carry out the audits of listed entities which are involved in complex groups, and therefore the focus is on systemic risks, those that are of a repetitive nature. But important to realize is that the regulator, and we'll see the extent of non-public interest audits that have been reviewed, and the regulator has indicated that at least 10% of their inspection resources will be allocated to non-listed work, because audit quality is audit quality, and therefore it's imperative that we look and ensure that there is audit quality that's at the right level for all types of audit engagements. Another primary theme in the 7th cycle is leadership. If you're a one-man show, well, you're the leader of your firm. If you work in a slightly larger organization, well, unless there's leadership accountability, the results of findings and the concern of repeat findings is that they shouldn't be recurring, but they are, and therefore there's now joint accountability with the engagement partner as well as the CEO or managing partner of the firm, particularly when it comes to matters that are as a result of firm policies that stem out of ISQC1, the International Standard on Quality Control. Linked to leadership is that tone at the top, because if management, if the CEO is not committed to quality, well, the entire, no matter what anybody does, the entire system of quality will not lead to an improvement in audit quality. And the impact of this leadership and tone of the top is that the regulator now is communicating directly with not only the engagement partner, but the managing partner of the firm, so that reports and responses to those are then going to all interested parties, and the managing partner also very much in the forefront. The other aspect of leadership involvement is in the remedial action plan process. And that is where one takes the identified deficiencies and then evaluates those deficiencies to determine what is their root cause. And we'll have a look at the extent of management involvement in this and the success in identifying those true root causes. And once, if one's able to identify a true root cause, well, then one can put in place policies and processes and procedures which will then alleviate these audit deficiencies. We know that we've had the collapse of a medium-sized firm some time ago in South Africa. For those of you that are aware, an entity with the name of Mkonki. And we've had enough negative media around auditors. And what's a key driver in that that's coming out is the lack of independence, and this we'll discuss, we've discussed in from an ethics perspective, is very much focused around the independence from a appearance point of view. So it makes no difference what one does, but if a person from the outside, from an objective point of view, doesn't appear to be independent, well, that's a failing of the code. And as regulators and commentators have said, this had led to the lapse of audit quality. And when ethics isn't adhered to, remember ethics being that requirement of taking a moral obligations and defining it in a professional code of behavior, which then determines the way in which all professional accountants need to conduct themselves. Another key focus of the 7th cycle is stemming from the quality control standard, acceptance and continuance, one of those 7 pillars, and making sure that when firms engage with new clients, that there's an appropriate evaluation of clients, of the risks to accepting a new client, and an understanding of that, and a resourcing of the audit team, and then looking at a continuance with a client, whether or not a firm has met the ethical requirements to continue servicing that client. I'm aware that a certain client of mine has got a agreement with one of the big four that where a firm gets to a size that is too large for their resources, well, they will then refer it to one of the big four. And, you know, the big four, the partner that they deal with, has got a reciprocal relationship where they'll refer work back to them. What's key is quality across all audit engagements, irrespective of size or industry. And this is what the regulators identified as a key concern. And then no CLAR, the non-compliance with laws and regulations, a new, relatively new aspect of the code. I think it's been around now 2 years, and making sure that that is adhered to, in addition to the Auditing Professions Act and the Reportable Irregularities and the reporting thereof. In terms of the 7th cycle, some of the firm focus areas is looking at ownership structures, making sure that there is a appropriately constructed board representative of the ownership structure. Interestingly, the firm that collapsed, Conky, majority of its shares, even though they had many directors, majority of its shares were all sitting and concentrated in the managing partner. Another key area in the firm inspections is that of the independence procedures, making sure that there is adequate consideration of all staff, of if you are part of a network, that these are adequately considered, and making sure that you look at these prohibited services from the Companies Act as well as from the code to make sure that one's not falling foul of that. You know, gone are the days when the regulator only looks at audit files. I remember when I was still in public practice, when the regulator was questioning partner performance and evaluation systems, it was questioned as to say, what is the right of the regulator to get involved in this? But international research, and as a result of IFIA, the International Federation of, Independent Audit Regulators, has revealed that partner performance and quality is very much connected to audit quality. And the same applies for remuneration. If remuneration is based on purely economic circumstances, profitability, well, that is then sending that wrong tone, the wrong message from management and from leadership as to what's important. If ethics is put secondary to quality, well, performance is then going to have a negative impact on quality. And then from the firm perspective, another key matter is to look at consequence management. To look at, well, if audit quality is found to be lacking, what is the direct impact? How are people accountable? Is there an adequately designed consequence management system put in place whereby there is an adequate understanding of the root causes, and then an appropriate action plan to address them, be that from training or whatever other area. And finally, what's also important is the key audit matters. So maybe just from a show of hands, if I can just ask, is anybody involved in the audit of any public interest entities or entities that report key audit matters? That's ISO 701, just so that I know how much time to concentrate on this area, because we do have a few other slides coming up. So I can't see any hands going up. So I assume there's nobody that's actually doing key audit matters. Okay. Great. Okay, so then let's get on to then understand then what is the results now that can come out of an inspection. And gone are the days where the regulator says pass or fail, or we're just coming back in however long, or now they've graded it into 5 different sections or responses. The first is no further action required, which is equivalent to the previous satisfactory result. So they say that's basically where no high-risk findings are found, very well-run auditing practice, and the quality of auditing files is then considered to be appropriate across all inspections. They then have some improvement required, where there are some findings that were identified, but nothing too significant, and that was equivalent to the previous satisfactory result, and then significant to the previous unsatisfactory result. And that is of particular concern, because this is effectively where audit quality was not at the required level. There's also a more serious finding whereby there's referral to investigation because of significant improvement required. And this is where the finding hasn't changed from the previous inspection. So that would result in a referral to the investigations department. And then there is a 5th rating, which the Inspections Committee, INSCOM, has included, being a pending result to allow for additional information to be obtained by inspectors before a final evaluation. So that's one where they haven't quite decided what the final rating is. Maybe it's still got to go through a QC process. Maybe the partner's responses indicate certain things, and then there's a follow-up request for additional information. And therefore, they will then hold off issuing that. I mean, I'm aware that also, I think with the change in the IRBA board, and it's still not finalized, we know that Bernardo Gullis has stepped off. We now have Imre Nagy as acting CEO of IRBA, but there's a new board that's been elected as a result of the previous CEO having been implicated in the Hewlett's mismanagement. So therefore, we see that this is an area of extreme importance, and what the economy takes a lot of trust and understanding and dependence from the regulator in this regard. So let's then understand from the perspective of the firm inspection, what is considered a reportable finding. And a reportable finding is something which is significant or a systemic deficiency, which results from the firm's conduct or the way in which they've implemented the quality standards, ISQC1. And what's important to realize is it has a possible impact on audit quality or risk of an inappropriate report. And, you know, people often say, but if my report's correct, well, why is this a finding? And we need to realize that if one hasn't complied with a particular requirement, then the implication is that, well, maybe one got it lucky this time. And therefore, if certain factors had changed or the audit had been conducted in a similar way, but the results came out differently, well, the report then may have then been inappropriate. And remember, the regulator's coming in after some time, and therefore there needs to be adequate consideration for adherence to the quality management standards, rather than just looking at the nature of the finding. And a reportable finding includes a failure to implement a remedial action plan. One of the cornerstones of the 7th cycle is that the firm needs to respond in writing with an appropriate root cause analysis to the regulator of the deficiencies that had been identified, together with a plan to action, which will then implement policies and procedures to remove these findings from recurring. And what we need to make sure is that if there is a lack of an adequate implementation plan, then the implication is that these findings are likely to occur. And if there's a plan that's submitted, an action plan that's submitted, which isn't then adhered to, well, then that one needs to make sure that that's then a lack of accountability, and therefore we need to just make sure that that is addressed and stopped, because this can result in a firm finding. Stan or Danny, if I can just ask you to respond to that question in the Q&A, just where the delegates can find the slides, how they can be obtained. I'm sure they were sent out. Thanks very much. Right, so let's then understand the purpose of communicating deficiencies, and There are a number of objectives. The first is to alert, depending on the nature, the type of deficiencies, to alert the firm or the engagement partner to any identified impairment of audit quality. The objective there is to also identify significant or systemic failures in the firm's system of quality, to develop a remediation or corrective action plan to address these deficiencies that have been identified, and then ultimately produce high quality audit, and then with regard then to ensure that that quality is consistent across all audits that the firm conducts. So for those of you that are looking for the slides, Stan did post a link in the chat, in the Q&A, where you can download them if you haven't got them already. Right, so what is particularly concerning to the regulator is that there is a number of significant recurring deficiencies, and those are in two categories: ethical breaches and engagement performance. And where a finding is identified and then it repeats itself, well, then there is concern that that is not being addressed, and once again, audit quality could then be impacted across various engagements. Ethical breaches take place at a firm independence perspective, so where the firm is carrying out prohibited services, for example, the drafting of financial statements together with the audit, or the firm providing services with another firm in the network. And just remember, just because you're not part of a network, you just need to look at that definition of a network firm, because it is very wide. You know, I'm aware of a situation where a engaged practice, an auditing practice, was involved in the audit and internal audit of an entity, and they had a certain staff member that broke away from them, and they were then opened up a compilation company where they would compile the financial statements, and this person so happened to be housed in the audit firm's premises, and you know, the regulator viewed this as a potentially extension of the definition of a network, because they operated from their premises, and effectively all their drafting work was sourced to this client, to this entity, I should say, for all of their clients. So we must just be very careful in this regard. And then auditor independence, where the auditor sometimes takes on a management responsibility or is involved himself in preparation of financial statements, or self-review threats from the code. All of these then give rise to significant recurring deficiencies that have been identified by the regulator. When it comes to the engagement performance, so a system of quality control needs to be developed and implemented, and sometimes that is not done appropriately, and promises are made and not adhered to. Audit engagement quality is also not at the right level, particularly around file monitoring reviews, external quality control reviews, so on public interest entities, and remember that's not restricted just to listed entities. In terms of the RBA code, a firm is required from next year to make sure that they define what their own public interest entities are in terms of their client base, and making sure that that is then adhered to, and the requirements of EQCRs and file monitoring is appropriately implemented. And finally, a significant recurring deficiency identified is that on the archiving or lockdown of files, there's a firm policy that files need to be locked down within 60 days of the audit report. And we'll discuss that in a bit more detail, but this stems down to the evidence that supports the audit opinion and making sure that that evidence is intact and unaltered, and number of firms failing to adequately implement a archiving policy. So let's now have a look at the firm-wide inspection themes and the results of those inspections. So in the current year, the 2020 period, from a firm-wide inspection, they looked at 8 firms. Clearly, they were concentrating on the larger firms, whereas in the previous period, they looked at 14. And of these inspections, 7 or 87% required significant improvement. If we look at that in comparison to the previous period, so we need to look at, of those 14 firms, 64% required significant improvement. 7% was referred to investigation, and 7% had some improvement required. So, you know, if we look at this, clearly there's a regression which raises the committee's cause for concern that the current year results continue to be indicative of systemic quality control deficiencies within some firms. The regulator has noted that there has been some significant improvements observed at a few firms where considerable investments were made in quality management, underpinned by leadership's sound tone, time and hands-on approach to create and sustain a culture and an enabling environment that consistently produces sustainable high-quality assurance work. In general, there have been findings across the entire spectrum of ISQC1 elements. These findings, most of which relate to engagement performance, speak directly to the inadequate establishment and implementation of policies and procedures designed to promote an internal culture that recognizes quality as essential when performing audit engagements. Therefore, the significant findings reported on the other elements in this report have a direct bearing on leadership's tone at the top in driving a culture of consistent and sustainable high audit quality within audit firms. So let's now look at the engagement level findings, and when do engagement level findings escalate to a firm deficiency? So you can have a problem identified on a file, but that then elevates to a firm level finding, so it affects not only the individual engagement, but also the entire firm. So the first area is where there's a significant lack of documented audit evidence in the engagement file to support the audit opinion. If you ever read the URBA news, there was a practitioner that was fined, I think it was close to 100,000 Rand on 5 different charges, so 20,000 each, on various aspects, because they'd carried out an audit and there was actually no working papers. Quite serious. Another area of a firm finding stemming from an engagement is the inadequate controls for safe custody and file modification, where engagement files are then available and sometimes have been modified after the 60 days, and sometimes even in anticipation of a URBA inspection. They've found evidence of that, and clearly that is unethical. I'm aware that there was a certain firm that was actually going around at one stage and was actually trying to help people prepare for an URBA inspection, which is obviously unethical and against the code. You know, yes, you can have a review, and you're required to ensure that your files are reviewed at a regular interval, just to make sure that there's an adequate evaluation of audit quality. But the purpose of that is to improve and develop a system to improve quality by way of addressing the root causes and a plan so that they don't recur, but nothing can be done to the file itself. Where there is pervasive disclosure deficiencies in the financial statements, so that where the framework has not been applied appropriately, but the audit report not qualified, escalation of that file finding to the firm level. And remember, this is critical across all elements and is being utilized by the entity. If there are independence breaches, well, that is stemming from the requirements of ISQC 1 and ISA 220, and therefore where independence has been breached, failure of the firm's system of quality control. This could relate to acceptance of clients for external services, where the firm, for example, was doing other services which would prohibit them from accepting that client. And then significant lack of documented evidence regarding the audit team's assessment of unadjusted audit misstatements and an inappropriate evaluation of the aggregate unadjusted audit misstatements. So one needs to look at them individually as well as collectively and on subtotals to determine whether or not there's any potential impact as a result of those errors. In terms then of the leadership, we spoke about accountability and the tone at the top, and what's come out clearly from the second cycle inspection report is that
breaking
to
up.
take responsibility. Okay, I'm not sure. Maybe I'll just repeat that. So when it comes to leadership, leadership is reminded of its responsibility to establish policies and procedures designed to promote an internal culture that recognizes quality as essential when performing audit engagements. Such policies and procedures require the firm's CEO or board of partners or equivalent to assume ultimate responsibility for the firm's system of quality control, and leadership is also governance principles within its firm structures and policies, in particular promoting an internal culture based on quality. That means that the firm's business strategy should be subject to the overriding requirement to achieve quality in all assurance engagements, including ensuring that commercial interests do not override the quality of audit work performed. So when we look at one of the advantages of the new format of the inspection findings is that they do look at the positive points where they have seen improvements, and what they do indicate is where there is hands-on leadership in managing audit quality and embedding a culture of quality, that has led to a significant improvement in audit quality, rather than managing quality and failures as a risk, that being a bit more of a reactive response, and therefore key that people look at this appropriately. So when it comes then to the findings, found that a defensive attitude or a complacency of accepting these findings doesn't seem to result in a improvement of audit quality. And therefore, what's critical is that there needs to be internal reflection, promoting the objective of audit quality, reflecting internally on root causes and the deficiencies and the findings that are being reported. In terms then of the lessons learned, enhanced accountability, taking responsibility for the deficiencies that have been identified, and looking at the audit quality and ensuring that budgets are appropriately set to scope an audit adequately, as well as the adequacy of sufficient resources at the appropriate level of skills required to carry out the audit, to ensure that such deficiencies then would not recur. With regard to the ethical breaches, so this includes, for example, quoting an audit fee that allows adequate time to be dedicated to complete the audit, utilizing the appropriate level of skilled resources, as opposed to charging inappropriately low audit fees just to secure an audit client. This is also in the context of tighter profit margins. Yes, one understands that the regulators are aware of the state of the economy, and the implication of stagnant audit fees, but one also needs to make sure that the fee is adequate and isn't set that it becomes a prohibitive up at audit quality. With regard then to acceptance and continuance, so there one needs to look at independence considerations and adequate evaluation of self-review threats is carried out, which will be subject to a review or part of the audit. Well, that brings about a potential
We seem to have lost Edwin. You there again?
Yeah, I'm back. I don't know. It seemed to just be having some bandwidth issues for some reason. Just let me reshare my screen again.
You want to take a break for a few minutes now, and because nearly 3.
Oh, sure. Okay, let's take a break and then we'll continue.
Come back at 5 past.
Okay,
or at 3 o'clock.
Or 3. You want to come back at 3?
No, 5 past is fine. Should be fun. Okay, we'll see
fine.
everybody in 10 minutes.
Okay.
Thanks then. Stan, can I just ask, can you still see my slides now if I've stopped sharing my video? Stan or Danny?
Yeah, we can still see your slides.
Okay, so what I'm going to do is maybe if I'm going to maybe just switch off my video if I see bandwidth becoming an issue. Okay, thanks a lot. Right, welcome back everyone. So let's then continue where we left off. If I do have some bandwidth of issues, which I hope have been resolved, I'm going to then stop my video just to make sure that we can run a bit smoother. So we're in the middle of discussing the firm inspection deficiencies, and what we need to be alert to is that failure to identify self-review threats detracts from audit quality in a significant way, and so much so that it impacts and detracts from quality, whereby a person would not even potentially be aware of the impairment of their independence, and therefore that is considered to be a significant concern. Another area where it comes to the acceptance and continuance of client relationships is where the firm doesn't necessarily have adequate internal resources. For example, they're auditing a entity in, let's say, a pension fund, a regulated industry, but they're not aware of and haven't had appropriate practical application of the regulators' responsibilities and the impact that it has on an audit. And then another concern is they don't have internal resources to demonstrate technical competence. For example, they're taking on an audit of a particular industry, but the concern is that they've accepted the audit, but they haven't even considered how they will acquire those resources, or where they're going to get these resources, and they don't have those resources internally at the moment. So I hope that's clear. In terms of a firm's engagement performance and engagement quality reviews. So part of a firm's responsibility in setting up a system of quality control is to establish policies and procedures designed to provide reasonable assurance that the engagements that it performs in the assurance space are in accordance with the professional standards, as well as there is compliance with those standards, there is adherence to the regulatory and legal requirements, as well as the codes of conduct, the ethical standards, and then there is a evaluation of the quality of engagements so that there is appropriate response to recurring significant deficiencies at both a firm level and particularly at an engagement, so at an audit client level. And the objective there is so that audit reports are then appropriate within an audit file, and there's adequate evidence on file that supports the audit opinion. Now, what that means is that there needs to be a proper consideration and evaluation of files. And if a firm hasn't got their own internal resources or they don't have sufficient capacity, well, then there is a need to outsource this responsibility, because otherwise there's a failure to adhere to the quality control standards which the firm is obligated to implement. And I mean, some clients, for example, have reviews that are conducted once every second year. Other firms are doing it more regularly, some once a year, some even twice a year, depending on the results of those findings. And this is internal monitoring that the firm puts in place. When it comes then to a system of quality control, the firms have demonstrated an ongoing failure to produce audits of a consistently high quality, considering the significant number and nature and extent of findings identified on audit engagement files inspected during the year. There was a concerning pattern observed at some firms where the majority of high-risk engagement files inspected revealed significant deficiencies, and this then undermines and casts doubt on the effectiveness on the firm's system of quality control and their quality control practices, and the ability of the firm's leadership to obtain reasonable assurance that the professional standards are complied with, audit reports are appropriate, and audits are performed at a consistent high level of quality, including being supported by sufficient appropriate audit evidence. The firm's approach and apparent dismissive attitude towards the RBA's inspection process, their findings, and the failure to recognize the regulators' objectives and roles in protecting the public interest and the reputation of the profession lead to a significant deficiency in the firm's system of quality control. A firm, in terms of the new code of ethics, code of conduct issued by the RBA, and in particular in South Africa, a definition of a public interest entity has been introduced, and that then gives rise to the need on not just listed clients, but on the firm's own high-risk clients, irrespective of whether they are listed, that there needs to be an external quality control review that is then conducted. And in that function, the RBA had identified that sometimes the firm had a policy in place, but those reviews were not performed, or they were performed, the review commenced, but it was never completed. There's independence and objectivity of the ETCR reviewer that hadn't been properly evaluated. There's an over-reliance on the external quality control reviewer. Remember, the quality control reviewer is supposed to be a second review after the engagement partner, and can't be the first, saying the first port, the first stopping point, and saying, well, you know, there's an external quality control reviewer, so the partner's then scope of review is sometimes compromised. The scope of the review needs to be adequately documented so that it is capable of re-performance. To achieve proper audit quality, the external quality control review involvement needs to be at regular stages of the engagement. For example, where we're involved in that process, we insist of being an observer to the planning meeting. After the planning working papers have been completed, we then get involved and review those working papers, the planning section. We issue a written report thereon. That's then followed by the execution phase with then a response to the planning findings to make sure that they've been appropriately addressed. And then we get involved in the finalization, including the significant risk areas are focused around the quality control requirements, as well as whether or not there is adequate evidence supporting the audit opinion and the significant risk areas and disclosures in the financial statements. A question: how are these issues addressed and implemented within the context of a sole practitioner? So the best way to respond to that is twofold. Depending on the firm's resources, so even a sole practitioner, if there's nobody with the equivalent qualification, another RA, so then one would need to either outsource this to a firm that specializes in these reviews. That's what Sole Consulting, the company that I work for, does. Or other people have an agreement with another sole proprietor where they will agree to review each other. You know, so, but one has to comply, and that's the objective of the EQCR function in terms of for your high-risk engagements. And remember, an EQCR is a review that takes place prior to the audit opinion being signed off. So a very important element in achieving audit quality. I hope that answers your question. With regard to the findings that have been identified by the EQCR reviewer, it's important that there is a proper implementation of those findings prior to the audit report being signed off. And linked to that should be a follow-up review as part of the engagement to ensure that the EQCR reviewer signs off on these findings prior to the signs off on these requirements prior to the audit report being issued. Another area of concern picked up by the regulators is that significant deficiencies that the inspections department picked up were not identified by the EQCR reviewer. Very important is that the scope of the EQCR review is adequate, and that should cover significant risks, key areas of judgment, significant judgments, as well as then key audit estimates, or significant judgments and accounting estimates. And those are required to be set in terms of ISO 220. And then another concern is some firms having this process in place, but the inspection files and process very much predictable and infrequent. I'm aware of some firms only have it when they know that they've got a regulator inspection coming up. And by then it's often too late because one hasn't got sufficient time to implement the entire ambit of quality control, particularly the EQCR function, because that has to be done prior to sign-off, and then it'd be too late. I mean, I had a firm that engaged us. We then commenced the planning. 2 months, 3 months went past, and nothing happened. Then we get a phone call, can we please sign off today? They're issuing the report. Obviously, that wasn't going to happen because that's then a scope limitation on myself. Another client we had where the report was issued and they asked us to backdate our EQCR report. And we said, well, we can't do that because that would be unethical for yourself as well as for us. So when it comes to then the monitoring process, leadership-driven investment is key to ensure that there's in-house technical resources, be that somebody full-time, or if the practice is too small, well, then there must be a ability to refer work to external consultants, but that mustn't detract from the engagement partner's own responsibility. And then firms, other key takeaways where they've seen significant improvements in firms is firms that select and adequately scope their internal reviews based on risk, or that increase the frequency, including random selection and authority of reviewers, tend to identify quality issues more effectively. Firms that invest sufficient time and effort in identifying the true root causes and have then constructive and prompt remediation to address findings and deficiencies have achieved a greater level of reduction in quality findings. Firms that invest in real-time monitoring of audit quality, making use of in-flight reviews, have proven to significantly reduce deficiencies at the engagement file level. This is something that's coming up more and more, where sometimes a person doesn't have the resources to do an EQCR, or but they are concerned, for example, of a particular scope or particular section, be that revenue or the new leasing standard or something, and they then have a review that focuses just on those aspects. Remember, from a quality control review, a lot of firms, what they do from a budgeting perspective is, if this is a high-risk entity, you know, on a listed client, obviously it's a lot easier. You can justify to the client and include it without any argument in the budget, because this is part of something that would have to happen at any firm. Whereas if this is a client for you is high risk, but for other firms may not be, then it becomes a bit harder to justify, but one should identify the need for an EQCR and set that up front. Entities which have an appropriate CPD policy development, whereby Stan and Danny and I were talking just before we started around the need to ensure that there is adherence to the CPD requirements, but now the CPD requirements are no longer hours-based. We need to make sure that whatever services you're providing, you are up to date and are receiving the necessary knowledge to facilitate the adherence of the services that you are providing at the necessary level of quality. And therefore, there also needs to be a CPD monitoring process, whereby not only is there a policy that's developed, not only do you come up with your plan, your CPD plan, but that needs to be monitored to ensure that you are then achieving the correct level and are applying the knowledge in the areas which are then necessary. In terms of then the monitoring of findings, so the monitoring review process is quite encompassing, and part of the monitoring review process is just the monitoring of files. There's also the monitoring of the entire ambit of quality control. So monitoring is the review process, and then there's the file monitoring. And what the regulator has said is that reported on the monitoring side is that reported deficiencies are sometimes not being identified because for whatever reason, and it's important to try and identify why, but a firm's having monitoring reviews done, but there's deficiencies that are not being identified by the internal monitoring reviewer. Maybe they don't have the necessary level of experience, or they're not familiar with the industry or the complexities of the nature of the client. Sometimes the scope of the review limited or restricted because of budget constraints and therefore inadequate. Other concerns that have been picked up is disagreement with the outcome of the review. In some instances, the RBA inspector or reviewer had a significantly different view as to whether or not the firm's evaluation of the cumulative findings and the ultimate rating given to that review was adequate. And another area of concern is insufficient evaluation of the competence of the reviewer, as well as the independence to determine whether or not the reviewer, the person that had carried out the review, had the sufficient skills or not. In addition, failure then to communicate and evaluate the significant deficiencies. It's all very well getting a report, but if nothing happens with that report, it just goes to file 13 or some file that's equivalent to file 13 because nobody looks at it. Well, then it isn't achieving the objectives of the monitoring. And then failure to remedy systematic or repetitive deficiencies. In other words, findings have been reported, but nothing generally happens with those findings. We've got a client where it's a medium-sized practice, and once a finding had come up on 2 of the 5 partners that were subject to a review in the current period, there was a meeting of the partners and a discussion as to the nature of these findings, the severity thereof, and a adherence and commitment by the partners to address this immediately. And then despite written formal root cause analyses and remedial action plans submitted, there's then a lack of the firm implementing its own recommendations and undertakings to the regulator as to how audit quality and file monitoring reviews are going to be improved, and ultimately then significant deterioration in audit quality at these engagements. So the lessons learned when it comes to the monitoring: firms that selected and adequately scope the internal reviews based on risk, or that increase the frequency and authority of the reviewers, tend to identify quality issues more effectively. There needs to be adequate development of staff and focused in this area in particular. Firms that invest in sufficient time in identifying true root cause analyses are way more successful in addressing the issues that cause deficiencies. And firms that invest in remedying reported deficiencies in a constructive manner and prompt manner throughout the firm tend to reduce recurring findings way more effectively. The CPD policy development needs to focus on particular skills shortages that the firm does have, as well as the random and frequency of monitoring reviews. And then there also needs to be CPD monitoring to ensure that this is appropriate. And then these in-flight reviews whereby firms look at specific areas of risk that they have, be that at the engagement level, and then leadership take responsibility to ensure that there is a second oversight of those specific areas to ensure that deficiencies in these areas can be reduced. We spoke about the file lockdown, and when it comes to a firm, the ISA 230 documentation standard says the completion of the assembly of a file for an audit must take place within a reasonable period of time after the report is issued, and only administrative matters can be utilized, can be amended in this file, which is the aspect of taking evidence that has been obtained and documenting it in the working papers. Examples would be that of what would be allowed in this 60-day period, that 60 days after the report has been issued, is very limited. It's deleting or discarding superseded documentation, sorting, collating, or cross-referencing working papers, signing off on completion checklists relating to the file assembly process, not checklists relating, for example, to the compliance with the framework, and documenting evidence the audit has obtained, discussed, and agreed with relevant members of the engagement team before the date of the audit report. Audit working papers, the regulator found, had been inserted post the 60 days. That's a contravention of the lockdown requirements, together with tampering with the audit file. And then some firms had documented evidence that files had been accessed post the 60 days, but there was no evidence of what modifications post-lockdown were actually implemented. And that's a requirement. If a firm is going to access a file, for whatever reason, they need to document which working papers they've accessed, the purpose thereof, and what's been looked at, and if anything has been changed and why. And it's interesting, auditors that made themselves guilty of this misconduct were found to be not to be in compliance with the auditing standards and the URBA Code of Professional Conduct. And therefore, such matters are often referred immediately to the RBA's investigations department pending disciplinary action, and because of the severity of the nature of flouting the policies and procedures around the integrity of the working papers. The final aspect I'd just like to touch on is, from the firm's perspective, is when it looks at reportable irregularities. So, first of all, the RI requirements are that a practitioner is obliged to communicate when they have identified a reportable irregularity to the RBA, and that needs to be within a reasonable time. A colleague of mine was reviewing a working paper file, and they noticed there was an audit qualification. Sorry, no, well, not an audit qualification, a report on matters of non-compliance around the RI. And unfortunately, when one looked at the working papers, the letter had only been submitted a month after the audit report had been signed off. The final matter that I'd just like to clarify is, last year in February, the Chief State Law Advisor certified a bill to Parliament, which now has been legislated, and that is that a client cannot dismiss the auditor while the auditor is in the process of reporting a reportable irregularity. And also, if an auditor resigns from a firm, so say it's a two-man practice, so that auditor then has to give full disclosure to the incoming auditor. Note that the auditor cannot be dismissed from the practice, but if they resign and leave, then there needs to be a proper handover. Right, I don't know if there's any questions before we go on to the next section, which is the engagement inspections. Okay, can't see any questions in the Q&A. Right, so let's then get focused now into the engagement inspections, or file inspections, as they're more commonly termed. And I suppose the first point we need to clarify is, what is the regulator deemed to be a reportable finding? So URBA clarified this in the inspections report, and they say a reportable finding is a significant deficiency that results either as a result of the inadequacy of, or the insufficiency of, audit evidence, or the appropriateness of audit evidence. You'd be surprised how many times the regulator picks up that the direction of testing was incorrect. And the reason there is, sometimes we'll see, is because of the inability to identify the true source documentation. We'll discuss that when we get to revenue, for example. And a reportable finding is also something where the possible impact on audit quality or the risk of an inappropriate report is present. And this would stem from a failure to address material or possibly material financial reporting or accounting matters, if there is any non-compliance with any of the auditing standards, the code of conduct, that's the ethical code, any legislation or regulations, or the firm's own policies, procedures, or methodology. And therefore, the financial statements may be materially misstated, or there's a risk that an inappropriate audit opinion could be issued. Readers need to ensure that when they look at the inspections report, that they look at it with the purpose of quality of audits and the improvement therein, and how they should then be applying their own judgment. So let's then have a look at the 7-cycle engagement file inspection results. And in the 2020 period, the regulator conducted 149 file engagement inspections, which were all then reported to the inspections committee. Of these, 17% required no further action. You can see percentage-wise that stayed pretty much the same this year versus last year. 20% required some improvement, 39% required significant improvement, and 24% were referred to the inspections, to the investigations department for investigation. You can see that's up slightly percentage-wise on last year, but in terms of numbers, significant increase as a result of the larger number of audit files that were inspected. The individual assurance engagement inspections covered 149 inspections, but that was 141 registered auditors and 33 audit firms. The results are concerning from the regulator's perspective because there is a continued deterioration compared to the previous year. That is a 36% positive inspection outcome for 2020 versus a 38% in the previous year. And as we're saying, this is on the backdrop of more inspections, file inspections that have actually been conducted in the 7th cycle. So a question being asked is, if a client has a pervasive systemic bookkeeping accounting deficiencies and inadequately trained bookkeeper accountant, what is the practitioner's response for this? An audit or a review? So to respond to your question, I think we need to take a step back, and the first question we would need to ask is, well, what gives rise to the need for an audit or review? And that would then be dependent solely on the needs of the client, together with the entities, if it's a company, its memorandum of incorporation, whether or not an audit's required in terms of that, or if it's still using the old articles and memo that hasn't been changed, then an audit would still be required. And then the requirements of the Companies Act. If the Companies Act, because of the entity's PR score, or and also taking into account whether or not the financial statements are internally or externally compiled, all of these together with the PR score have an impact on the level of assurance that needs to be undertaken on that entity. And therefore, if an entity is required to have a review because of its PR score, but the entity requires additional assurance because of the uses of its financial statements, well, then an audit may be required. But if an audit is required because of its PR score, well, it makes no difference what the level of bookkeeping is at the client. This would then be need to be carried out to comply with the director's responsibilities for that entity. The response, though, is if, for example, you've got a choice between an audit or a review, because the entity says a review, well, you think maybe an audit's better. Well, it's definitely less risky to do an audit because your scope of your procedures is that much less, but you still need to get sufficient work and support for your review conclusion in terms of ISRE 2400, the International Standard on Review Engagements, that would be then applicable. However, if an audit's elected, well, the extent of work now that you have to carry out as a result of the inherent risks that you are aware of because of the lack of accounting knowledge by the bookkeeper or accountant, well, that would then need to be incorporated into the cost of your review, because that would then significantly impact that. I see there's a follow-up question, Anthony. I'm still not understanding the context of your question. So I'm not sure if you can just provide me with more clarity, because I obviously haven't answered it, but I'm not understanding the question then properly. So I'll just continue and then I'll look at your response just now. So in terms now of the what the regulator has done is they've also analyzed the findings between listed entities and unlisted entities. Sorry, listed versus PARs, public interest entities, and unlisted entities. So where it's not even considered to be a PAR. And what's interesting is that in the current year, we see that there were 70 unlisted or non-PAR engagements. And of these, 17% required no further action, whereas with the listed or PARs, 25%, so clearly showing that there is a difference in the level of audit work on unlisted versus listed. Interesting, in the prior period, the 2019 period, you can see on the unlisted, it was slightly better, but this has deteriorated in the 2020 period, and therefore a area for concern. And this supports the regulator's view, the IRBA's view, that the quality on unlisted work and those that are less likely to be subject to a inspection then being brought into question, the quality thereof. So in terms of the significant recurring findings on a file level, so there are a number of engagement deficiency themes. The highest is the financial statements and disclosures, and particularly the statement of cash flows. The audit of the statement of cash flows left pretty much to accounting software or drafting software and not actually interrogated, and significant deficiencies identified in there. Remember, the statement of cash flows is one of those primary sets of the financial statements upon which an audit opinion is being expressed, and therefore there needs to be adequate work done on that. That would include the financial statement disclosures, which extends to the notes, and then supporting work for the financial statement presentation and disclosures. The other significant deficiency is revenue, particularly completeness, and completeness of the populations utilized for the testing of that revenue population. Next is significant estimates and judgments, including evaluation of goodwill intangibles. And if you think, well, I don't deal with that, so not my problem, but including in accounting estimates is residual values and useful lives of PPE, still an area of significant concern for the regulator. And then other concerns is just the lack of adherence to general auditing principles, in that inadequate documentation for evidence, risk assessment, particularly fraud risk assessment, and drilling it down to the assertion level to understand, well, as a result of a potential risk of fraud, where is the audit focus to mitigate that risk? The assessment of materiality, planning and final, quantitative and qualitative assessment of the unadjusted audit differences, which we spoke about earlier in the file review, sorry, in the firm review findings, because where this has a direct impact on the audit opinion, this would then be elevated to a firm response. And then, interestingly, the financial statements accounts for 23% of the deficiencies, revenue 18%, the accounting estimates and judgments 10%, and as I've said, that's not only goodwill and intangibles, but those were the key main ones that have the most significant impact, and then 6% on these general audit principles. So we're approaching 5-2 now. So I'd like to propose another break. Danny, I'm not sure, should we go for another 10 minutes, or should we, would that be adequate for everybody? And then we'll start addressing.
If you know where you're in your material, this is a natural break. I think it's a good idea to take a break now.
Yeah, this is the good spot. Okay, great. We'll start going through the detail afterwards. So then we'll see you in 10 minutes, because we've still got quite a bit to get through. Thanks a lot.
Edwin, when you come back, there's Tony Roth added to his question.
Thanks. Yes, I was just reading it. Thanks, Danny. So, so just to clarify, if an entity requires an audit, so in case one, you've got an entity that qualifies for an audit and it has a bookkeeper who's inadequately trained, and you uncover numerous pervasive bookkeeping errors, and the same then applies in an audit. So in an audit and a review. So the way to respond then would be the extent of work that you then need to do. You know, with a review, if you're able to limit that work to the extent that you do not need to carry out audit procedures, and you're still able to get sufficient evidence that the information is credible, that it's plausible, then you no longer have a responsibility to be able to carry out any further procedures. If, however, you're unable to do that by performing review procedures alone, well, then you would need to then carry out procedures that may be similar to an audit in the review engagement. But in either situation, the extent of work that you would have to do would be more than if it were a client that where the bookkeeper was adequately trained, and therefore, as a result thereof, that should then have a direct impact on your budget under the circumstances, because you know that the entity hasn't got sufficient controls, hasn't got adequately trained staff, and therefore the nature of the errors and the work that you're going to be doing is that much more significant, and therefore that's how you would need to address that. I hope that answers your response, answers your question. Thanks. Okay, so then moving along now to the audit report and the financial statement presentation. So on the audit report, matters identified there is that there's a South African Auditing Practice Standard 3 that's been issued. Sure, it's been running for 20 years at least. And this takes the auditor reporting standards and gives practical guidance in a South African context, and sometimes the independence requirements, the effective independence standards at different dates with the different long-term association and the new parts 4A and B being effective at all different dates. So one needs to make sure that that report is appropriately drafted, and there's a requirement from the auditing standards that the auditor discloses what level of, which ethical independence standards they've complied with, and that wasn't adhered to. For those of you that prepare consolidated financial statements and audit those, or your clients prepare them and you audit them, the audit report needs to make a clear distinction across the entire set of the financial statements need to be appropriately disclosed, referencing to both the separate and consolidated, as well as the audit report to clarify, and if there's qualifications, where those qualifications to what that relates. If you do audit listed entities, so audit tenures are required mandatory disclosure. So, and there hasn't been any evidence either on file as to what the audit tenure is, and sometimes that had been calculated incorrectly. Remember, by 2023, public interest entities, listed entities in particular, are going to have mandatory firm rotation. So that's why that's a critical disclosure that the regulator is looking at. And then key audit matters, so evidence of the procedures and boilerplate disclosures, but from my understanding, there's no one here that's doing that, so I'll be brushing over that quickly then. As we said, 23% of all findings related to these presentation and disclosure. And on the financial statements, the number one concern, I mean, we've looked at probably in the past 2 months, myself, in terms of the monitoring reviews that we perform at SORI Consulting, we've looked at about 8 files, and I think 7 of the 8 of them failed on the non-cash items because the cash flow is then materially misstated. Where financial statements have been restated because of prior period errors, the basis for the restatement in terms of IAS 8 or the IFRS for SME equivalent, not adequately described in the note, and therefore financial statements not giving a fair presentation because one doesn't understand what the nature of the misstatement was. On the non-cash items, another area, sorry, on the cash flow statement, another area we're picking up significantly in the reviews that SORI Consulting conduct is the area of the classification between operating, investing, and financing activities, sometimes that not having been appropriately audited. On the statement of financial position, current versus non-current classification, if an entity has a loan with another entity which has no fixed terms of repayment, often in related party loans or directors' loans, well, if that's a liability, if there's no fixed repayment terms, it means it is current. The same applies if there's a subordination agreement. Subordination changes the other party's ability to claim payment. It doesn't change the obligation of the entity to repay. And then for those of you, maybe just from a show of hands, does anyone prepare IFRS financial statements or audit financial statements that have been prepared on the IFRS framework? Just if I can just have from a show of hands, just raise your hand, because otherwise I can go through that in a bit quicker, just so I know how to address it. Okay, I'm not sure. I think you can raise your hand, but if you can't, if you can just put in your in the Q&A, it just goes to the delegates, sorry, to the presenters, so we'll just see it. If you do IFRS for SME financial statements, audit thereof, then I'll spend more time, but unless I hear from somebody, I'll be glossing over that slightly quicker. Okay, thanks. So I do have somebody who does, so then I do need to pay attention to this. So then on the IFRS 7 disclosures, that's the financial instruments. There's a requirement that, thanks to the two of you who've responded. So there's a requirement around the liquidity management, financial liquidity, those IFRS 7 disclosures. There needs to be, it can't be that the working paper becomes the extract of the financial statements. It's that there needs to be adequate testing of the amounts included in those different categories, as well as the sensitivity analyses around that, for example, and the notes in particular around sort of fixed asset recons, etc. All of these information needs to be appropriately audited. IFRS 13, if you have instruments at fair value, well, there's a hierarchy classification that needs to be presented. You've got level 1, 2, and 3, depending on how observable the financial inputs are. Something like traded on a stock exchange would be a level 1, whereas a model would be like a level 3. And then goodwill impairment, specific disclosure requirements. If you are under IFRS, full IFRS, around the goodwill impairment that management need to present in the financial statements, and that includes the assumptions, growth rates, discount rates, etc., that have been utilized. All of those need to be audited in with sufficient rigor. If you're on IFRS for SMEs and your entity has goodwill, well, then you need to consider if the entity is writing off goodwill over 10 years, on what basis is it doing over 10 years? IFRS for SMEs says you go to 10 years where you don't have evidence or it's deemed to be an appropriate estimate of the useful life. But management need to be able to justify the 10 years or 6 years or whatever other period. And then a big concern of the regulator, directors' emoluments, the disclosure inadequate in terms of the Companies Act requirements. Section 30, subsection 4 and 5 of the Companies Act give the detail of the disclosure required in this regard, and that being not complied with by a number of entities. Remember, this is something that the SIPC is also monitoring quite closely, and I'm sure this is information that's being utilized by the receiver of revenue. And then also the completeness of the director's emolument disclosures around the different categories, services, etc., all those pension funds, other benefits, etc. All of that level of detail is required together with a person's name. That's from the Companies Act requirements. One can't just list it as one lump sum or Mr. X or something. One needs to give the details. So when it comes then to the financial statements and the audit report, so firms need to make sure that they select and adequately scope the internal reviews based on risk, and they need to have a person suitably qualified to perform an independent review of the annual financial statements. And then there needs to be appropriate training and development on financial statement disclosures. I'm not sure, Stan and Danny, and maybe those of you who are online, if this is another topic maybe that we could focus on for the next 6 months, if there would be an interest in something like that, please communicate that to Stan, Danny, and I'd probably be able to develop something. The second most significant area of concentration of findings related to revenue. And we know ISA 240, the fraud standard, has a rebuttable presumption of a significant risk of fraud in revenue recognition. But the regulator has found there's insufficient justification for that rebuttal, despite it being utilized in numerous circumstances. And therefore, the recommendation is, if you do have revenue, rather assess the risk as high rather than rebut that fraud risk. That's become a default practice in certain firms. And then Sorry, give me one moment. And then with regard then also to the different streams of revenue, it's important that one focuses on all streams of revenue, because the risk of fraud applies to all streams of revenue, not just the main stream of revenue, and therefore it's imperative that the response to that risk is appropriate. With regard then to the completeness assertion, once again, one needs to be concerned and identify and obtain evidence for the completeness of all streams of revenue. Maybe they've got dividends received, sale of goods, sale of services, because they do maintenance or something. One needs to make sure that one's carried out sufficient work on all the different streams of revenue. And just because something's not classified as revenue, maybe it's classified as other income, well, one needs to be very careful. Just because it's presented in the financial statements as other income does not mean it's not revenue, and the ISA 240 requirement is not applicable, because in terms of what standard would that be measured? Probably the revenue standard anyway. Remember, the extent of documentation needs to be sufficient to enable a reasonably experienced auditor to understand and arrive at the same conclusion. And therefore, when it comes to the source documents, one needs to have a clear understanding of what the initiating source document is. And remember, that's generally got to be something that is verified by a third party. If it's not, it's an internal document, and then you're not getting evidence. You're just agreeing one system to another. The completeness and accuracy of a population from which a sample is being drawn needs to be verified before the sample is selected. So if I'm selecting delivery notes, how do I know that I've got all the delivery notes from which my sample is being selected? And that needs to be documented. And then if one is looking to use analytical procedures to verify completeness, well, one cannot use non-predictive analytical procedures, because then it's not a substantive test of detail as required by the standard. So, for example, you say that revenue's gone up, and the reason revenue's gone up is because, the entity obtained a new client, and therefore, well, you believe revenue's complete. That's an example of a non-predictive analytical procedure, because it's not quantified, predictive in amount. More appropriate would be that, well, the entity has 10 customers in the past, they've assigned a new customer, that entity, the new customer contract is for R1 million. We expect revenue to be 6% up because of the price increase last year, plus R1 million for this entity. And if we then get within a reasonable tolerable error, which has also had to have been set up front, then we can say we've potentially done a completeness test. Okay, I hope that's clear. With regard then to the occurrence of revenue, sometimes no testing performed. It's an assertion, therefore one needs to get audit evidence. Remember, if it's a low risk, it doesn't mean no audit evidence is required. It just means the nature or extent of testing may be different, but one still needs to carry out audit procedures. Once again, sometimes the incorrect source documentation used, sometimes the test set up where you can see they've selected it based on a delivery note, whereas the test should have been, the direction of testing should have been from the general ledger. Lack of understanding of the revenue process and therefore unclear whether or not adequate occurrence testing has been achieved. Test not achieving the occurrence objective, so they set a test, but the test then doesn't actually test the actual direction which it's intended. And then sometimes in terms of sampling methodologies, excuse me, sorry, I had a sneeze I tried to get out, just didn't quite want to come. You know, sometimes in terms of sampling methodologies, one needs to identify or one has planned a particular, based on your sampling methodology, size, a sample that needs to be tested, but then one doesn't test that, or sometimes there's errors in that, or items that are cancelled, and then one doesn't land up replacing those. I was actually reviewing a file today where they did a particular test, and one of the transactions was cancelled. They selected the next transaction, and that was noted in the working papers. So then they are getting sufficient audit evidence. So in terms of the revenue side, firms that select and adequately scope the tests and define their populations and have proper system descriptions, and then ensure they have sufficient investment in time to develop staff as to what is giving rise to deficiencies, generally have a improved level of audit quality and a decrease in these findings. In terms of the significant judgments and estimates, so evaluations of misstatements, we spoke about that with regards to the audit differences, but on the substantive procedures where management makes an estimate and the auditor makes an estimate, but they are not adjusted by management, and that's not been qualified, well, that's clearly a evaluation and error that would need and should have had an impact and detracts from the quality of the audit. Material differences carried to the schedule of overs and unders. Well, if it's material, it needs to be adjusted. If it's appearing on the schedule of overs and unders, that must result in an audit qualification. On the intangible assets, and particularly property, plant and equipment, useful lives are an estimate. How long is an asset going to be utilized for? If an entity is writing assets off down to R1, well, they're not applying a useful life. They're not reassessing it adequately. If they're on IFRS for SMEs and they've got R1 assets, well, if they're approaching R1, it's indicative that the useful life is inappropriate. The same with residual values. There needs to be evidence of the residual values, how management are applying it. Componentization, no, it does not apply to aeroplanes only. If an entity's got significant plant, machinery, one needs to consider that, and one needs to document this and show that one's considered it for all items of PPE. And then an impairment test where there are, and depending on the framework, one needs to sometimes carry out an impairment test where there are indicators. From a full IFRS perspective, goodwill impairment required on an annual basis because goodwill on full IFRS is not amortized, whereas on IFRS for SMEs, like we said, that is amortized, but one still would need to be on the lookout for impairment indicators. Intangible assets, pretty much the same as the PPE side of things. Evaluation of judgments needs to also focus on going concern. If an entity has incurred losses, well, what's turning it around? Are there profits in the current year? Are there budgets? Are those budgets being achieved? Sorry, one aspect I did forget to mention just was probably a key concern now is COVID-19 on the financial statement disclosures. Not something that's coming out in the reports yet, obviously, because that was up to March 2020 inspections. But please do focus. There's a lot of guidance by the RBA on COVID-19 and the impact that should have on the audit. Debt equity classification, you know, if an entity's got loans where the person subordinated or agreed not to repay, well, that's clearly still debt versus a redeemable preference share that would be something like equity. And then subordination agreements, all very well having a subordination agreement, remember, it doesn't change the nature of the item from current to non-current. It still remains current, but one also needs to get evidence that that subordination agreement has restored solvency or liquidity, I should say. And then what's happened if there's been breach of debt covenants? You know, if an entity failed to pay a loan on time, even if it was a day late, well, that's a breach of a debt covenant, and then the entire liability would need to be classified at year end as current, even though it had subsequently been rectified post year end. I hope that's clear. Right, and then in terms of other judgments and estimates, where one's looking at valuation experts or aspects around IFRS 9, the financial instruments, the different provision matrices, maybe they're using complex things, or pension funds, retirement benefit obligations, etc., actuarial valuations, or the most common expert, quantity surveyors. Those can be internal or external to the organization, so somebody employed by the entity or somebody external. Well, there's appropriate standards, ISA 620 for auditors experts and ISA 500, I think it's paragraph 8 of the requirements, how you would need to apply that for a management expert. But even if it's not somebody that management employs externally, but that's somebody that the organization utilizes, they have their own quantity surveyors, well, then you need to evaluate those requirements and audit that similar to a external audit, external expert. And then complex accounting, blind reliance, where you've got these experts, business combinations, joint arrangements, etc., useful life assessments. One needs to evaluate and interrogate the experts, so one can't just take the report and file it and accept it. With regard then to the goodwill, so we've said that that's an area of concern, and particularly the testing of goodwill at an inappropriate level. Remember, goodwill needs to be allocated to separate cash generating units, the lowest CGU as it's called, and then tested for impairment. With regards to the inputs into the goodwill calculations, or the same would be to a going concern budget, one needs to check whether or not those inputs are appropriate, whether or not the assumptions are correct. From a goodwill perspective, the disclosures need to be in terms of IAS 36 requirements. There needs to be an understanding of the goodwill and to what it relates. And when you drill down on that, sometimes you realize that the cash generating unit to which it belonged is no longer intact. If it's for SMEs, a justification for the amortization period we already discussed, and then insufficient evidence of the figures used in the calculating or valuing the goodwill. All the inputs need to be verified before to get sufficient evidence. From the accounting estimates perspective, the lessons learned needs to be a proper application of professional skepticism. The auditor needs to challenge the estimates received by management and the assumptions that management have adopted. There needs to be a documented basis of how the auditor is applying professional judgment for accepting those judgments, and then the acceptance of management's overall estimate. With regard to the risk assessment, so there should be a risk assessed for all account balances, transactions, and disclosures, as well as then a risk at financial statement level, and then a fraud risk assessment needs to be distinct from the risk of material misstatement at assertion level. Sorry, if you can just ask you, I just picked up, there's a slight typo there that shouldn't say room, that should say risk of material misstatement, ROMM. So if you can just please update that, something I noticed somehow it just auto-corrected. So I've just corrected it there, ROM. Risk of material misstatement, your slides say room. And then your risk assessment rating needs to be justified. If it's not high, well, on what basis can it be reduced? And wherever there's a risk, even if it's low, there needs to be an appropriate response to the nature, timing, and extent. And then the risk where there is a risk of fraud, well, it doesn't say, well, we're going to increase professional skepticism. We need to apply that to specific areas, to specific accounting estimates, to specific assertions to determine what are the specific procedures that we are going to then be carrying out. And then audit sampling, not correlated with risk. Where there is a high risk, the sample size should be that much more than a low risk in terms of whatever your sampling methodology is. We spoke about cash flow statement. Other non-cash items as dividends, for example. If a dividend is accrued, it's not a payment. It hasn't been paid, it's not a cash flow. Leases, and particularly with IFRS 16, the new leasing standard for those of you auditing full IFRS financial statements, these amounts are non-cash flows. The cash flows are the lease payments, but when they enter into a new lease, the new lease is not a cash flow. So that needs to be adjusted as a non-cash item. And there should be document procedures for all amounts presented. So for example, your working capital notes, those needs to be tested. The repayments of loans, particularly with related parties or directors, you can't offset those inflows and outflows. One needs to show the gross inflows and the gross outflows, even though it's the same account. They are different cash flows. Some have been repayments and some have been additional advances. Fieldwork, there needs to be appropriate evidence for assertions, for every single assertion. And then other areas of concern is lead schedules, sometimes not agreeing to the financial statements. And you'll say, well, what's the big deal? No, the impact is maybe your sampling and your extent of testing is then wrong, because your lead sheet, which should be the basis for the work that you're performing and from which you determine your sample size, isn't then appropriate. On the completion or finalization stages of the audit, if errors are identified, one cannot conclude that these exceptions are adequate without being extrapolated. And this applies particularly to clearly trivial errors. If you've got an error in a sample, you need to determine the impact, or sorry, the quantity of that error, first of all on the total sample, and then on the entire population. And then you determine whether or not that is clearly trivial or not. If it's above clearly trivial, then it needs to be posted to the summary of overs and unders, or your summary of unadjusted audit evidence, audit differences, whatever you call it. Very important is the impact, the qualitative impact of errors, not just worrying about the monetary, and this is of particular concern, for example, for the disclosure of directors' emoluments. Lack of a review by the engagement partner of the working papers, representation letter not signed by management or signed after the audit report, and then date of subsequent events and going concern assessment needs to be done before the date of the audit report. From a documentation, the majority of findings reported in the inspections report relate to a lack of documented evidence on file, supporting the auditor's conclusions and opinions. ISA 200, paragraph 17 states that to obtain reasonable assurance, the auditor shall obtain sufficient appropriate audit evidence to reduce the risk of to reduce audit risk to an acceptably low level, and thereby enable the auditor to draw conclusions as to, and thereby enable the auditor to draw conclusions on which to base the auditor's opinion. These findings include insufficient testing at assertion level, inappropriate source documentation, direction of testing, insufficient extent of testing, etc. And if the evidence is not documented, a third party is unable to re-perform it, and therefore it is considered as if the test had not been appropriately documented and had not been carried out. A reminder when auditing journal entries, one needs to be cognizant of the risk of fraud as a result of management override and the direct impact that that has on journal entries. And therefore, there needs to be testing of manual journal entries, non-recurring and unusual journal entries. And then one needs to have a system description because of that significant risk. And there needs to be a testing specifically of material end of reporting period or financial statement closing process journals and adjustments. Those journals in period 13 or close to year end need to be specifically scoped within your audit procedures. Reminder with regards to cost of sales, substantive analytical review is often insufficient or and even inappropriate under most circumstances to get evidence on the cost of sales. Cost of sales is a line item disclosed often in the financial statements, sometimes not, but it has an impact on profit before tax, and one needs to, and depends on the nature. So just make sure that that is properly assessed. And also important is the classification between cost of sales and operating expenses, depending on the level of detail in the statement of comprehensive income. Other significant areas of findings: related parties. There needs to be a test to determine whether or not related party disclosures are complete. Remember, there's a requirement from IFRS and IFRS for SMEs, irrespective of the nature. So irrespective of whether they're balances or transactions, the identification of related parties needs to be presented. And then sometimes the regulated identified material related party transactions had not been disclosed and not been identified by the practitioner. Important when your client is approving the financial statements, one needs to make sure that the financial statements that are approved together with a final audit report and that approved set of financial statements is appropriately disclosed. And then there needs to be, if you are involved in entities which they're publishing it and they're sending this to typesetters, well, you need to make sure that there's adequate control and address the risks of what happens if those financial statements are then typesetted or something, and there's a risk that the audit report and or the financial statements may change from those which you've audited. For those of you that are involved in the consolidation and the auditing of consolidated financial statements, where the exemption is applied, that the ultimate holding company, for example, is preparing consolidated financial statements and therefore consolidation at a lower level is not required, well, that needs to be documented and audited. We spoke about the SARPS 3 requirement, that the financial statements not, the audit report and financial statements not appropriately addressing the consolidation, and there should be disclosure requirements of IS 27, that the separate financial statements not being met. The final stage of the session I'd like to address in the last 10 minutes is the remedial action process. And that is what the regulator has identified as key to reducing the recurrence of findings, together with, as we said, leadership and the tone at the top. And as a result of monitoring reviews that you have planned and required to carry out in terms of your quality control manual, well, linked to that is to monitor the results of that, and what's important is to carry out a root cause analysis and a remedial action plan. And what the regulator is presented here is the effectiveness of their root cause analyses that have been presented by audit firms. And what's comforting to see that there's been an increase from 48% to 57% of the adequacy of those root cause analyses. And the improvement also on the remedial action plan being effective for now 89% of remedial action plans that have been presented. So let's then understand then what goes into these root cause analyses and the remedial action plans. And the first thing that we need to understand is what are the top 5 root causes? So why is an auditor getting something wrong? And the top 5 findings or responses by firms is sometimes a lack of review or the review process failing. Lack of training because a person wasn't aware of requirements. Time pressure because of deadlines or the audit wasn't scoped properly. Lack of applying professional skepticism. That would be very applicable to the accounting estimates. And maybe the staff competency or capacity not at the right level in terms of the to service the clients that the entity has. So in terms of then the objectives then of the root cause analysis and remedial action plan is to take prompt and a notable improvement in audit quality by auditors on all their audits. The objective is to strengthen the impact of inspections by reducing recurring inspection findings, ensure that there's responsive reaction to the identified deficiencies and their root causes so that action can be taken. The RBA has a separate person, a person by the name of Peter Klutter, who's heading up the remedial action process. And he visits firm, and this keeps the RBA fully independent. And then leadership remains fully responsible for implementing the root causes and then ensuring that there is appropriate remediation. With regards to the remedial action plans, 46, it's interesting, 46% of firms did not identify true root causes. Other firms' remedial action plans were not measurable. And there needs to be an appropriate tool utilized for the remedial action process, particularly the root cause analyses. And that would be one of the examples, one of the most common used tools is called the 5 whys, where you ask, if you're a one-man show, you need to do it with your audit manager or some of your staff to say, well, or let them ask the questions, well, why did this arise? And that question is repeated 5 times until you get to the ultimate, the true cause. Other responses is to look at brainstorming around what areas could lead to improvement. And then important that audit regulators around the world have found that prompt remediation of findings has a significant improvement in the reduction thereof. So in terms of lessons learned, professional skepticism needs to be applied across the board, particularly around management estimates and where judgment's involved. And then enhanced accountability. Different practitioners within the firm need to make sure that they are accountable. And then there needs to be improved ownership of the findings. And that leads to a reduction in the recurring deficiencies. So How then, what are some of the ways in which one can look at a common finding and then identify what an appropriate root cause could be? So let's look at some of the common ones we've been discussing. There's the SCF, non-cash items being presented, or incorrect classification. So an appropriate root cause could be lack of review. I'm just going to switch off my video. I'm seeing I'm having a bit of bandwidth issues. So apologies, my face has disappeared. So appropriate root causes could be lack of review, improper procedure execution. So a planned procedure wasn't carried out. Maybe staff that were allocated didn't have sufficient understanding of the requirements. Maybe they did, but they hadn't been trained. Maybe there wasn't sufficient understanding of the financial statements and the disclosures and the framework and what goes into a cash flow. Or, you know, the matter was just trivialized, made a non-issue. Revenue, completeness of population and source, inappropriate staff allocation. This is not something that a junior can do. A senior or somebody with a bit more experience needs to evaluate this. And then with regard to accounting estimates, lack of understanding of the process, lack of professional skepticism, AFS disclosures, lack of review, improper procedure execution, or I'd add here, lack of appropriate staff allocation. And then for audit evidence sufficiency and appropriateness, staff capacity or time pressure, or sometimes even budget. So what's the regulator got planned for the future? So we've got new quality management standards. We've also got a staff alert for those of you that are doing IFRS 15, full IFRS. That's the new staff alert on revenue and what needs to be included. These here are just some of the focus points of the regulator. I'm not going to go through that. You can read that. But I do want to just address this last slide just to focus a bit more on the COVID-19 and responses and understanding the impact of the pandemic on the client, client reporting timetable, risk assessments and fraud risk in particular, the impact that this has had on audit evidence and the collation of audit evidence and working remotely. You know, one still needs to get sufficient appropriate audit evidence. Group audits, going concern, subsequent events, accounting estimates, all of these matters have an impact of or are impacted by COVID-19. And please make sure we're still in the pandemic, that your audit procedures are addressing these and the financial statements are disclosing the impact of the entity. And management have considered it, and you've got evidence in that regard. And then lastly, just from the rotation of auditors, remember we've said there needs to be a working paper. So we said that that's a disclosure for listed entities where mandatory firm rotation is going to take place. There needs to be a working paper that evidences this, so that there is adequate consideration, because the regulator picking up that this hasn't actually been taking place properly. Right, with a couple of seconds to spare, we've finished. So thanks very much for attending. I don't know if you have any questions. I'll stay on for a couple of minutes longer. Thanks very much.
So yes, so thanks, Edwin. That's a very interesting discussion. I'm sure it all works. Just I suppose adherence is the problem. And maybe I should just put a word in the flea in the ear of government, but I never said that. But thanks very much again, and I hope if there are questions, please address them and address them now in the chat or the Q&A. And thank you everybody. Just stay safe. I see today the number of deaths has gone up dramatically. And so stay safe and just, it's a dangerous time. I wish everybody well. I see there is one question.
Oh.
It's gone.
It was just Anthony saying thank you. Also, then just please note, in a month's time, we got Munir Hassan doing a debt relief tax implications, and David Tucker on body corporates financial statements. Well,
okay. So if there's no more questions and everything, thank you, Edwin. Thanks, Danny, and good night, everybody.
Cheers. Thanks,
Signing
everyone.
off.